Good day. This is the Eye of the Storm podcast with the big picture update for the SPX, the NDX, the 30-year bond, the 10, 5, and 2-year notes, gold, silver, and the dollar index. Starting with basically a little bit of an overview, last week was wild and it was more than crazy. We had so many things swirling around all of our markets, actually, as volatility increased, decreased, went sideways, went up, down, and all around in the indexes, in the individual stocks, in the treasuries, in gold, and also in the dollar. So everything is picking up speed in terms of indecisiveness, in terms of fear, in terms of complacency, all of the above. Then we wrap that all up with last week. We had a Wednesday expiration for volatility products. Then we had a Friday expiration, which was a monthly. So it was a little bit larger type of an expiration in equities and indexes and futures and treasuries, et cetera, et cetera. And we had bank failures. We had the Fed stepping in, the FDIC stepping in. We have rumors swirling around that the Fed's got to pivot, the Fed's going to pivot, the Fed's got to ease, the Fed is easing, et cetera, et cetera, et cetera. So let me dive in here and try to put together what the expectations that I've had for quite some time remain in place, particularly within the treasury markets. So starting here with the SPX, on my daily, again, the larger picture has not changed. What got shifted around ever so slightly was how this all was unfolding right here within this initial starting phase for the intermediate degree C wave down. And so within that, we're going to see 5 waves of minor degree, and they're going to be labeled 1, 2, 3, 4, 5. So we have basically, let me just bring it all the way down quickly to a 4-hour so we can see it. We have minor 1, then we had this terrific irregular B wave as a part of minor wave 2, a fabulous C wave rally, and that put in the high for minor wave 2. Then it started to get a little hazy, a little crazy as we came down nicely in 5 to put in minute wave 1 of this minor wave 3. Then it got a little crazy right in here. And what ended up, and my first belief was what ended up like from last week, was that the minute wave 2 was here and we were starting down in a minute third wave. Well, that got interrupted, that shot the moon, and that raced the markets higher. So taking a step back out, we could see that this was A, B, 1, 2, 3, 4, 5, C. Now, I am marking this as complete, but right out of the gate, I got to say, even though this was a beautiful, what I would look for the start of a third wave down, and of that high being a completion point, as those that have followed me now for a while or just know from my previous updates, what I normally will look for is a rejection of the high. Here's that I got that, and all within Friday, that the high was made right at the turn from Thursday into Friday. So it was during Globex that we got these highs. And then the next day or into Friday, by the time it came for us to open, we were already heading lower and then had a pretty strong down morning on Friday, followed by just some basic chop for the balance of the day. Now, on the SPX, which is the cash market, it does appear that we likely have finished minute wave 2. Again, all of our moving averages on the 1-hour chart, 200's now kind of starting to go flat. The SMA, the 200 SMA still kind of angling lower. The 50 flat, the 20 angling lower, the 4, the 8, which really are just the precursors to the turn, and then acknowledging the turn, and then kind of stopping that steep slide we had, which is just all a product of what the market then ends up doing. Now, what I'm finding interesting is that we still have to actually leave open, because possibly, it's only 1, 2, 3 of the C wave, right? So the sub-minute C to complete the minute 2 may still be in progress, even though this is large. We've not broken any rules yet. But what would need to happen, folks, is that we'd have to turn pretty much immediately. Turn immediately and just start and marching up higher. Now, should the market do that, let's throw in just very quickly what it can look like and where it can reach. Right now, we pretty much got up to the wave C equal to wave A right there, 39.66. Friday's high was 39.64. Came within very close, came within 2 points of that ultimate first major Fibonacci resistance level. Now, if this is a 4, with this being the 2, this being the 4, they don't match. But, you know, the markets have been wild and crazy and putting in extended, not as extended, not really following the rule of alternation, which again demonstrates to me that with all of our trading being algorithmically controlled, with direction really being controlled by the derivatives, which are the options, so the options trading on the SPX, on the ES, on the spiders, on the individual companies under, you know, of the member components within the SPX, that it really is changing the size, the shape, and the patterns a little bit within Elliott Wave. Not necessarily the larger picture, but on our smaller, particularly hourly down pictures. So on that basis, we may come in tomorrow, starting right away, and then see a gap higher, depending on how they treat the futures. Tomorrow, once Globex restarts, we might get a gap and a quick run higher. That's all possible. There are many factors that are going to go into that. Primarily, though, it's going to be driven, direction, I believe, will be driven by what we see in the options trading. And then again, we have 0 DTE options that expire in the SPX and the ES and across the board. So they will begin to have a play as to where now we're going to peg this market. So what would pretty much cap this off is if we were to break down below 38.95. This is basis the cash. So let's call it 38.90 basically. And so we fall below this support level, 90 down to 87. It should tie it all up, give us this clean ABC up, and the start of this next 5-wave sequence down in the form of a minute 3. And that minute third will be of the minor third. So technically what we're moving into is a 3 of 3 move. It's the minute third of the minor third of the intermediate C wave. So that would give us a little bit more confirmation. Plus, what's also going to be, it should just continue, right? Remember, talk about the rejection? That I saw pretty cleanly on Friday. So we get a little bounce, as it should. And if that bounce is even over, then we should start to go very quickly. Now we're into the 3 of 3 type move, right? If I'm going to count this sub-minute 1, sub-minute 2, we're into sub-minute 3. It should not stop. It should just go bing, 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 and fulfill the downside. Now, this would be, again, if we still had a little bit of upside left to do. So we have that still 39.66. And then we have 39.96. So again, that 4,000 level basis to cash continues to lie out there as if trying to draw everybody back in. It's a resistance level that a lot of algorithms can just poke their code to include 4,000. We already know that via the futures market, the ES, that very often there's a lot of resting orders right there at 4,000, and I mean a lot. And that is like a magnet. It's a magnet for algorithms to get up there. It's liquidity. whether they're buys or whether they're sells, it's liquidity. And so when you are running an algorithm that has got a lot of size to do, you're looking for the liquidity. Where can we go to get all these orders? And then also there are algorithms that are just going to be set up to go in search of that liquidity, go and trigger it, and then reverse. So we got a lot of things in here playing. And quite frankly, most of them have nothing to do with what's going on in reality. It's numbers, it's a numbers game, it's options, it's trading, and that all swirls into these levels. Yes, there are many of us that would like to see all of this end and these windows of trade start to decline as the market should progress through the balance of this intermediate C wave down to finish just the primary A wave of this much larger correction that we've been in since January the 3rd of 2022. So again, I'm not portending, yes, what I'm presenting is going to be interpreted as like bearish. Let me make something pretty clear. I am not a perpetual bear or a perpetual bull. I trade the market as the market goes. So each and every day I get to come in. Where the problems can start to come is if people are a one-sided trader. So in other words, you're looking for what's the buy signal because I want to get long, and now I am long, so I expect it to go up, and the perpetual bear is going to constantly be telling you that it's not going to do that. Well, I think if we all put it into perspective that we're in a very long-term corrective phase, and the number of years, as I described previously in my long-term count, which I'm going to go do right now. We're going to give the long-term count for let me go out to the 3-year. I actually need to go further. Let me go out to the 20-year, weekly 20-year. You can see that we've had cycle wave 4 down here at the bottom of 2009. So as a minimum, because this all encompassed cycle wave 5, right? So cycle wave 5 went from 2009 to 2022. That is 13 years of rally. If nothing else, that's what we are correcting. So yes, we're in a larger corrective phase. Because the minimum that I'm looking for, and this would be minimum, is a drop down to at least the price territory of the fourth wave of one lesser degree of off a cycle, which is primary, and that is the pandemic low from March of 2020. That, my friends, is sitting down. This is basis to cash, 2,192, I'll call it. That was the low. Now, Elliott tells us to look for if we're looking for the decline, right? And I'm looking for at least a cycle or a primary degree, right? I'm looking for primary wave A. Where can that come in? I think primary wave A might come in at 2980 up to 3000. So we do have a little bit more to go. Again, I'm on a weekly chart. This is the big picture. But ultimately, I think that cycle wave A, not primary, one more degree higher, cycle wave A, which is going to consist of a primary degree A, B, C, should come in here. Then we go into a cycle B wave. Then we still have a cycle C wave yet to come. So there's still a lot more to come. Because remember, this fib line goes back to 1932. So if I jump out one more to my monthly chart, really what is in process is a super cycle. Those are the lighter blue, a super cycle wave 4 correction. Where does that kind of suggest that we can go? Well, I have to go, a super cycle wave 4 should find its terminus, its ending point within the price territory of the fourth wave of one lesser degree. Super cycle, one lesser is cycle. Well, according to Elliott, this is where we should be looking. And that, my friends, is 667. And everyone's going to jump on board and put into the comment section that I'm nuts, I'm crazy, and I'm a perpetual bear. I'm not. I'm just giving you the numbers. I will trade whatever the market gives me. I will trade it going up. I will trade it going down. I am not setting up positions that's looking for like June or July of 2025. I'm going to go be buying 700 level puts. No, I'm not doing that. I'm not advocating that. But I'm telling you, over the long term, now you get to shrink it down. All right, I can bring it down, and now we look at a weekly chart. Basically tells the same thing. So now I'm going to bring it down to let's look at a 3-year. There was the high. What's our first leg down? A primary A wave. Well, we've been involved in all of that, and what the market is actually doing is putting in a double ABC to form primary wave A. Now, being that it's all threes instead of fives, once we do reach our low and we get a primary B wave, because it's threes, Elliott did note that you run the gamut of the possibility of the B wave. In this case, it would be a primary B wave, so it should have some power behind it and some longevity behind it, that it could become an irregular B wave. Well, what would that suggest? We go up and we break above 48.18, which was the high basis the cash market. Now, say that when you're perpetually looking for lower levels, Michael. Well, because under the guidelines of Elliott, it's allowing it as a possibility based on the initial structure of what I will label as primary wave A. So if I get a primary wave A to come in down to this, by the way, 2980 is 0.382 of the entire rally phase from 1932 to 2022. That's just a 38.2% retracement of a rally that covered over 4,800 points, because that 1932 low was at $6.49. Subtract that. That's how much. 382 correction is basically 1,800 points from the high. Everybody's like, oh my God, it's death, it's destruction, it's this, it's that. It's like possibly, but you can trade it. You can be prepared for it. And you take it step by step along the way. You don't want to be holding a short if we're expecting a major rally back up. But you can trade it. You can participate. You don't have to be perpetual bull or perpetual bear to do that. You're just doing what the market is doing and what the market is showing us. So using Elliott, I'm able to put a little time factor around it, maybe, but I've got I have the signals continue to show that we have a major fallout ready to happen now. If I bring this back down to the daily, then I bring it back down to the hourly. We're sitting on the precipice yet again, and it's not the end of the world. That I'm not, although, you never know when that can happen, right? We've got a bunch of lunatics around the globe who've got their fingers on the pulse of a nuclear weapon. And I'm not saying that that's going to happen, but I'm just saying, when you're going to try to think about, well, what could happen, instead of being myopically focused on, look at the banking situation, the Fed's going to pivot, Fed's going to go into quantitative easing. Really? Why? I think what also, just to add into that conversation, which will tip over and go into when I talk about the bonds, is that the quantitative easing is just not going to happen in my mind. They may come in at 25 basis points, but I really do firmly believe that they do not continue to raise interest rates, inflation will get the best of us, and then we will have a banking problem. on top of runaway inflation, on top of a Fed who is not thinking and continue to think, well, we have to appease the markets here. We have to let everybody off the hook. It's like, why? Not raising the rates and letting inflation run out of control even harder than it is not appeasing me. It's going to hamper me. We're all going to lose money. Think about it. Stop trying to buy into a false narrative. We have no evidence from the Fed. The Fed, in their wonderfulness, I guess, or whatever you want to call it, have now opened up and put together various agencies within the structure of the Federal Reserve Bank, within the structure of the Treasury, within the structures of how we operate financially, to answer what's happening within the banking sector, to provide that coverage for all the uninsured depositors within Silicon Valley Bank, which, by the way, declared bankruptcy. They filed for Chapter 11 bankruptcy on Friday. So this concept of like, well, everything's wonderful, everything's great, the Fed stepped in, they're going to lower rates, is not putting the whole picture together. Now, that would catch me by surprise if they actually decide, you know what, folks, we're not going to raise it all, and we're now going to ease by 1/4 point. So I'm going to talk about it in a moment, but I just want to get through the SPX and the NDX. I will talk about interest rates and how I have been looking for this counter trend rally to pick up steam and go again. Just so happens that we have a banking crisis. We have, which could be systemic. We still don't know if it can be or not be systemic. So again, there's a lot of unknown facts within all of this. So take it one day at a time. Take a look at gold, folks. Look at this rally on Friday. Gold was up $70. Do you want to wonder why? What does that mean? What are traders really looking at? If you have a little history on gold, you're going to understand, and I will talk about that in just a moment. Getting back to the S&P here so that we can move on. Initially, now for next week, I got to leave open that we might first go up and put in a finishing rally to complete this minute wave 2. There's our levels. If it's going to continue to go lower and it's dropping into a third, it's just going to go. What do we have next week? Nothing really major in terms of numbers. But what we do have is on Wednesday, the Fed interest rate decision, along with the Chairman Powell's press conference. Now, if they want to take anything from the ECB again on Wednesday, I believe it was, raised their rate 50 basis points. And the one thing that Legrand, who is the head of the ECB, what she said was that they're going to discontinue forward guidance. It's too dangerous. It's just too like not going to happen. We're in too many problems that each central bank needs to deal with. And how they deal with it moving forward, it's just like last month when we got our rate hike. Do you think that they were sitting around going like, well, gee, should we do this because we're going to have this systemic bank failure problem? No. They were hiding behind closed doors in terms of Silicon Valley Bank, in terms of Silvergate Capital, in terms of Key Signature Bank, wondering how they were going to get out of the problem because they bought treasuries at extremely high prices and we're now collapsing. So that's the other thing. When you hear anybody say, well, the Fed's got to ease to give some relief to that, bull. Those are bad positions. That's not up to the Fed to go bail out a bank because they use their depositors' funds to put these positions on. That's just bad trading by all the banks that did it. It's bad trading. Period. So I would be against the Fed stepping up to protect that because the bank had bad trading, put on bad trades and did not do anything when interest rates started to go up to put some protection around their massive position. enough said. So we have that Fed on Wednesday. So the market could sit here and do sideways, a little up, a little down, a little up, a little down. And then on that Wednesday, depending on what comes out, we get what we want. My Elliott count is suggesting that they're going to raise at least 25, maybe 50. And the reaction, of course, is going to be a quick slam dunk in the bonds. All right, because they're all moving for safety. They're all doing all kinds of things in there. If you follow Elliott, you were expecting it. That's another one. Boy, the volatility within that 30-year bond market is extraordinary right now. And I'm talking about premium moving in and out of the options like there's no tomorrow, and there might not be. But just as a trader, the volatility, the speed of these moves up to above 132 in the 30-year bond and then dropping back down has been spectacular. And catching those moves are gigantic. And why? Because in the 30-year bond future, it's $31.25 a tick. And there are 31 ticks to the 1 point move. It's huge. All right, moving over to the NASDAQ. Basically, it's the same thing, but they're coming in a little bit differently. In this case, the SDX on the hourly chart is pretty cleanly saying that we need one more rally up. Now, again, this could be over as well, because in the futures market, it's presenting a little bit different picture. This is the cash. So I may have to switch it around because I think we had a little bit more decline here. This 3 could come here. We got a 4 and then a 5, and we're going to head lower. All right. Future trades much more in terms of hours after this is closed or before it can open. That's why we get our gaps, both directions, by the way. So if indeed this is what's going to hold, because that's how I really do need to count it right now, in all fairness, we got these are the minute levels. That should all be right there, and I'll line it up. So minute A, minute B, minute C for the minor wave 2, which in the SPX, we're counting as complete. So again, different wave count, basically, right? We had that clean ABC, and we had a clean first wave down. So we're in still a minute wave 2 there, but in the NASDAQ, it's a minor wave 2. So it's one bigger. And because the market is doing this. So the NASDAQ has had the much bigger reaction on all of this. Still rallies against rallies, but it's how it's all being counted. So why in the SPX I do allow for one more new high is because it's kind of hedging on that within the cash market for the NASDAQ. So I'm going to leave it open. So we have minute A, minute B. We're in minute C of minor wave 2. So within that C wave, which consists of 5 waves, we have 1, 2, and then it breaks down 1, 2, 3, 4, 5. Now that again, the 3 could be here. This happened overnight, so we don't see it. Then we get this, and that could have been 5. And now we are also starting down. We'll get our answers. First of all, some Globex tomorrow afternoon or evening, and then Monday morning. So this won't trade tomorrow. The trades on Monday morning is when they resume in the cash index. But we'll get a lot of answers from the futures market tomorrow. If in case I'm leaving open the possibility that we will go up one more time, and I just want to put, yep, it's set up. I'm going to go up to here, down to here. You can see we're really sitting right up here, right up to resistance. Can come back up, equal that, go maybe a little bit above, maybe get up to 12,700 basis the cash, and then put in a 5, and then we just nosedive. So, but what goes against that is the fact that we have the rejection. Is it all the way 4? Sure. Under Elliott rules, yeah, it fits. It fits very cleanly. This is kind of flattish, or maybe it's going to be a zigzag. I don't know. But again, I'd have to allow for it all the way down to 12,076. Or if this is going to be 1 and this is 2 and this is 3, then they can use that at 12,225. Again, this is basis the cash market. So I'm going to leave all that open, the possibility. But if we come in and this thing just gaps lower, which many people are expecting, if it just gaps lower, then this is done. And the minor wave 2 goes up here, and we're in the beginning stages of a minor third wave, which again, as I continue to say, will start by a total rejection of that high. And that may take several days as we roll out on an hourly basis and put in 5 waves down. Now, here are moving averages. I'll go out to the daily and we'll take a peek so we can see. On the daily, look at that 200. I mean, it's almost like it's just a trend line going straight across our chart. With that massive rally, with this rally, it's still as flat can be. Shows the 200 SMA, flat as flat can be. The 50, it's trying to kind of pick up some speed to go up. The only thing that's really answering to the call are the 4, the 8, and the 20. And the 20 is a little bit reluctant. So much so that this dotted yellow is the 8 SMA, the simple moving average, which a lot of people do follow, versus the EMA, exponential moving average. So it's now trying to get itself above. Against having done that, but it's hesitating. Why? Because we started to come off. So moving average wise, they're not really telling me we're going to go. The hourly still has that potential. 200s are still heading up. The SMA just got crossed by the EMA on the 200 level. And then the 50 still heading, the 20 starting to kind of go like, well, wait a minute, we're not going to go up that fast. And the balance is flat. All right. Over in the interest rates, they have been extremely volatile. Let's go out and show you what's happening. I know I'm clogging up my own monthly chart, but this is where I'm putting all the snapshots for where these interest rates closed. Now, remember that I've been talking about that we've had the first 5 waves down, which I'm labeling as an intermediate degree A wave, but an A wave nonetheless. Degree, it's in question, but not necessarily that important right now. More what the move we are expecting in response to this first 5 waves down is more important, and that's going to be an ABC counter trend rally. Now, it is within that we did the A and the B, and we're in the C wave, which is in up, which means rates decline, bond prices go up. We've been looking for that, and it was always a part of the conversation. And you can go back and listen for go back a month or so, and you'll hear me talking about the same thing. An ABC rally. And against, in fact, I even brought up several times, I would have no idea how the market's going to perceive the bonds going up and equities going down. Because we've got all this interest rate going like, aren't we sitting in that position right now? Interest rates are dropping a little bit, and that's just via the bond. So the yield on the bond, not rates themselves, the yield on the bonds are coming down. The yields on the very short-term treasuries have declined along with it. But let's take a look. On March the 3rd, 2 weeks ago, we reached 4.03. Well, that was the bottom of the B wave within the ABC up. Now we're finishing it. And look how fast. We've come off 40 basis points in 2 weeks. Those are gigantic moves, folks. So while they try to price the banking failure, what's the Fed going to do? Are we going to have a rate hike? We already tried to price in 25 basis points in a week, right there. Now we've got another 10. So to total almost 40 basis points in 2 weeks. These are big moves. These are very big moves. Very confused market. Because when it starts to come off, we're going to see a day where the 10 or the 30-year note will probably be down 3 or 4. And that will go along with the markets actually just hightailing it to down. All right, so let me come down all the way to the daily so we can see some of these internals. This is the October low, October of 2022. So since that point, I've been talking about an ABC, which is why these numbers have never left my chart. Those are the ones that are going to correspond with what can we expect within this ABC. Well, so far it hasn't even gotten up to the absolute bare minimum, which is 135.13, which is, for the bond price. And when the expectations of a B wave, if we just follow B waves and what Elliott tells us and how those Fibonacci retracements come into line with a B wave, we're looking for at least 382. That's 146. Well, the fact that they've not even been able to reach this one, and we've got all this disturbance in the force around interest rates about, they're gonna have to drop, they're gonna have to pivot, they're gonna have to do this, they have to. Doesn't mean much because it's failed to even get above some pretty basic levels to get it up here. And now the big question is, will they have enough oomph to get themselves above? And if the Fed, what if this is the part that'll drive you crazy? Follow the market. If we break above here, then we are likely going to be heading much higher. Now, again, I can do the same thing. I'm going to go to top of wave A down to the bottom of wave B, and here we have it. 100% where wave C would be equal to wave A, that comes in at 137.25. Well, if Friday's highs in the closing area produces like, what did I say, 33.6? What's another 2 points? Probably 3.5, maybe 3.3. If it could get there. It's got resistance at, still resistance at 133.15. It's gone up and touched it, got above it once. And that possibly could have completed the whole thing, right? Here we have 134.03. That's the high right there from January. We need to get above that. Well, we got 134.17. Can happen. And doesn't mean that the Fed's going to cut. They could do that on Monday. They could do it on Tuesday. The volatility is what's really screaming for us to trade this market. If you have an account that you can handle the trades, if you have an account with enough, capital within it that you can actually trade this, because this is a very, very big contract. It's a big contract. And like I said before, $31.25 per tick. But when these moves, and I'm talking like short, like within 5 minutes, I'm moving 10, 20 ticks. And the clip, bing, bing, bing. And it's just big money on a one lot. Don't have to go in there and trade a lot. You got them one lot. Not sure, but I actually believe that the bonds have a micro contract as well. In any case, they weren't actually. They're designed for hedge funds and just mutual funds and for the long term. Investors can go and invest in the long term, buy U.S. treasuries, et cetera. So they're not really set up to handle everything that they got to handle right now. So we do have upside. But again, a lot is going to happen on Wednesday that's going to seal the deal for one way or the other. If we're going to continue to get up to these higher levels in bond price, or was that it? And now we start to decline again. If they come in 25 to 50 basis points, if they equal it, what they're telling you is like, yeah, we got this other part under control, folks. That's a whole different agency within the agency that's taking care of that has secured that financing to go bail out all of those uninsured deposits. It has nothing to do with inflation. Now they got to deal with inflation, and that's the conversation that they have to have at the meeting and decide what we're going to do moving forward. Those numbers weren't great last week that came out to indicate what's going on in inflation. They weren't stellar. They weren't like, oh my God, this all just backs up. We're back in heaven here. We're just like cruising along. None of that. And if you're long looking for rescue, you're going to believe anything somebody tells you that's going to cause the market to go up. I really just think it's like, secure your position. Be ready for either side. And then be able to trade. The other thing I recommend, just keep trading. Don't get stuck that you buy and hold and then get mad at everybody who wants to give you a downside view, and you're in love with everybody that wants to give an upside view. Just trade. Trade the moves. Be more flexible. Maybe you're not able. Maybe you're not have that capacity within your account. But this is what I see. So we have upside targets. We got downside, and if the downside kicks in, it's going to go very quickly. That would be my same thing. I'm looking for the equities to go. If the interest rate, if treasuries get any inclination, like, no more rate, they're not going to be cutting here. They're not even going to ease us and give us a stay. So you could say a stay of execution, almost like a stay. It's not going to happen. If it doesn't, ding, 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 we're going to see a big reversal. Over in the 10-year, we're just going to go down our list here. 10-year note, absolutely same story. Let's take a quick peek out there, because where I put what we're going on. So 2 weeks ago, on the 3rd of March, we reached a high for rates at 4.08. 1 week later, we dropped 30 basis points. 1 week additionally, from that high, we've dropped 60 basis points. So the 10-year note on its run to finish this minor C wave up are annihilating. So the 10-year note flew right past. I'm hoping this is correct, because I did go look it up on different charts. And that we came down that hard, that fast in the 10-year. So it actually widens the inverted yield curve even more. It's kind of interesting. But this is a massive decline on the 10-year note. And I would suspect, and it's not doing anything other than really within the realm of reality. But look at this volatility. That's the 10-year's volatility kicking in. Those are huge, huge moves in a 10-year note. And just on other indicators that I have available, where we can show where large orders, I don't know if they're selling it up here and they're buying it down here, but the huge orders were down there around the 114 level on Friday. And the market came down, filled them, and then ran. So it's interesting, even in the treasury markets. But we have continued resistance at 116. We need to get above 116, 165. That was the top of the B wave. We got this beautiful C wave down, and 1, 2, 3, 4, one more. Get above this level, maybe even as high as 117, 260. So what's going to do that? I think just the hype and the tension from what the Fed's going to do on Wednesday could do it on Monday or Tuesday, or even just get above 116, 205, excuse me. That puts in a new high. Then we can possibly complete the minor C and the intermediate B, and it sets the stage for another bond market collapse, interest rate hike. The yields will soar as quickly as they dropped. Down on the 5-year note, same story. So all of the interest rate markets were basically going a little bit crazy trying to determine, how do we price all this activity in? So here on the 3rd of March, 2 weeks ago, we were at 4.32. That was all the way down here. Then on the 10th, we started to drop, right? And right here, we were dropping 30, actually almost 40, but 36. Let me do my math correctly. That's a 2, 92, 30, 36 basis points in 1 week. Then we dropped to 3.72. This is 5-year. 3.72 off of there. Wow. 60 basis points. Same as the 10. So this is pretty amazing. But guess where we are? Back up at the top for our C wave. They're all in the, you can see, they're all in the exact same patterns. Even though that came down all the way and touched, even went a little bit below the October low, which gave us a little head fake. It really did. Oh, it's like, oh my God, we're going to go down now, which gave me that, if you remember, I had an alternate account, which put the B wave up here, which means we're in that next C wave down. And it's going to be ugly. Well, that stopped, obviously. But look at tails, 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 tails. Even on the daily chart. So we have a lot going on. What do we need to get above? That A, which was at 110.300. We're not really close. The closest we've gotten is 110.137. I'm looking for, this is the 4, and we got a 5, and maybe we get up to 111, or at least above 110.305, which is just below 111. So we need to kind of get up there. It could come in close and then still turn, and then it would be a very small failure in terms of the C wave not being able to take out the high of the A wave. Not a disaster, because actually I'm not looking for much. It could be totally flat, and anywhere near that would be considered a flat, right? The A, the B, the C, all basically equal in length. So if it doesn't quite get up there and turns, that's going to be very acceptable. Now, down to that infamous 2-year. This is the one that'll just kind of knock my socks off at what it did. It was at 4.89. Don't forget, we had the short-term paper punching above 5%. The 1 year down on in Treasury bills, cleanly above 5%. They've also made big drops down in the last auction. People wanting to just park their money and get something with the instability across the board. So from 2 weeks ago, a 4.89. Last Friday, we witnessed basically a 29 basis point drop from the previous week's high. And then off of, in another week, we had a 46 basis point drop in the rate. Now from this high, it is 3/4, 75 basis points from the high. That's what we've now witnessed in the 2-year note. Look at that rally. This went down, broke to a new low, and then absolutely exploded. Covering shorts, do whatever you got to do, folks. That's what it was. We had 3 days of massive rally, and then one additional massive rally, which took us up. Now we're above. We are above. We hit 1.382. If this indeed was the completion point of the B and it came in irregular, that's kind of strange now, isn't it? Then what we're looking for is maybe 104. We're there at 104. We closed just under 104. We could get there again. We have made our new high. If we're going to push one more, we got 104.153. Then we start to tumble. And I want to tell you, I really do believe we'll get a C wave down. Whew. This marks the B wave. We get a C wave down. We're going to have a lot of this, but in the opposite direction. There'll be a lot of catching up back to do. A lot. So what's the picture that we're building in terms of the big picture? What's happening in interest rates? What's happening in the equity markets? What are they really building towards? They're building towards falling off a cliff. That's my best interpretation based on the wave patterns that I see. based on me, what I'm thinking, that we got this A and then a B, and we've got a C wave. So if I just stick to the technicals, folks, the technicals are not telling me we're going to drop back into the low interest rate environment, that the Fed's just going to just QE our way out of this problem. No, the reason we're in the problem is because of QE. So to think that they're going to go back to that, would smart money would be like, oh, really? That's what you're going to do? So not mark the word, but just think about this. If they don't raise the interest rates, if they decide to hold pat, how are traders going to take that? We have retail that's going to go like, Yahoo, Mountain Dew, lower rates. It's like bull. It would create a disaster in our monetary system within the United States. What it tells me is that we have a very weak Fed that doesn't have the guts to stick to the plan when inflation is not showing that it's really getting any better. I'm tired of hearing these year-over-year numbers. Check out exactly how they're calculated. Year over year, and then tell me inflation's better. Really? So the last ones was March of 2022. When did inflation really start to kick in? April, May, June, July of 2022, all the way down to the end of the year. So you're going to do March over year over year? It's insane. It's already a setup as an illusion. Think about it. In any case, 2-year, maybe you've reached its high, and we're going to start to sink. We shall see. Let's get over to gold. Stunning is the word I would use. Stunning, this rally. Now, here's the thing to know about gold traders. Gold traders hate uncertainty. Hate uncertainty. Where are we in the world? In very, very uncertain times, right? What do we got in terms of Russia and the Ukraine situation? We have a court somewhere, I believe it's in The Hague, that put out an arrest warrant for Vladimir Putin. Now, either he's laughing or he's going to determine that he's going to really go smash the Ukraine into his smithereens right now. Just bring out death and destruction. We got North Korea that's threatening the United States. If you do this, we're going to come after you. We do this, we'll show you our power. Rhetoric, yes. Can he push a button and cause some trouble? Yes. These are just brewing fires that we got, right? Ukraine, definitely not settled issue. Definitely not a settled issue. We got other issues going on in that region. We got issues going on with Israel. We got issues going on around in many different areas. Now add into that a global banking problem, right? Credit Suisse got bailed out by the Swiss National Bank, by the Swiss Central Bank. And that's after the Saudis pulled and said, nope, we have no interest. Sorry, we were going to go and help, but we're not going to go do it now. Sorry, we're out. So it was either Credit Suisse, a major, gigantic bank on the global stage, going down for the count. But the Swiss Central Bank decided to step in with $54 billion. Is that enough? I don't know. I don't know where their problems were. But they saved the bank for right now. Because and remember, things roll downhill. So I don't think we're really getting that whole picture. Then we have the European Central Bank did follow through and say, we're raising rates 50 basis points. We have the institutions in place to deal with the banking crises that are happening in little pockets around, right? We come back over to our own country, and we have where, if you just listen to, there was an exchange between one of the senators, it was a senator from, I believe, Oklahoma, one of the Midwestern states, who was asking Janet Yellen, if now that you've decided that you're going to save the depositors from the Silicon Valley debacle and they're uninsured, so you're going to step in and pay them. You're going to give them their money back. Well, what happens to all the regional banks that are being affected by all of this? And he referred to it in his own state. Will you step in and bail out those depositors? And her answer was no. Now, that would have stopped anybody in their tracks going like, really? Really? So in favor of the big banks, you're going to allow all the little guy and the smaller depositors who absolutely count on that money. You have a problem? Not my problem. You just go away. It said volumes. Now, again, Treasury, FDIC, Fed, they're all in this. And by the way, because Republic National, which is centered here, their home base is here in San Francisco. And guess what? They're a wealth bank. They're not just like, anybody can just walk in and say, here's my $25. I'd like to open a Christmas club. They don't offer that type of stuff. They only offer things to the wealthy. And we have a lot of billionaires in San Francisco, folks, a lot of billionaires in the area, and they're very big. They ran into trouble too. I wonder how. But what do we get? JP Morgan, Chase, we got Goldman Sachs, we have Morgan Stanley, we have Bank of America, Wells Fargo, Mellon Bank, New York, US Bank, and one other, I think there was 6 or 7, that stepped in and gave First Republic Bank $30 billion. Okay, what's that really all about? You need to look into that to see exactly what the deal is. Does it really save them? Investors didn't think so on Friday. The stock dropped another 32% after the announcement of the rescue package. There's trouble ahead. Gold sees it. Now, going back to my Elliott count, I'd label this 1, I'd label this, I need to put a 2 down there. And we're above that. We sailed above 1975 and got very close to 2000. That was a massive rally in one day. So here's our fibs, right? Taking it from the bottom of what I call the C wave, or that minor wave 4, or fourth wave of what? We're not sure yet. So wave 1, ABC wave 2, 1, 2, 3. There's a little bit more. 1, 2, and then 1, 2. Are we going to continue to soar? Here's our numbers. Wave 3 would be equal to wave 1 at 2,135. This is the third wave. You see the power of it coming. You see the power of it coming. I would surely expect this third wave to possibly get us up to 2,334, which is 1.618, where this third wave would be 1.618 of the first wave. So what do we have? We got coming up 2011, yeah, bad number, 2037, 2066, 2135, 2212, 2260, and then we get that 618, 2336. Now, how fast could it happen? Well, it did 70 bucks right there. One day. We've seen it go up and down 100 points before. What if they add 100 to this? And we're sitting up. We're like, this was it. Now we're sitting 100 bucks on this. Is almost 2,100, almost up to here. Push a button, get it together. Gold traders. Now, one other thing that I want to share with you. When we take a look, and I got to go back and I am going to find it, and you guys can't see it because I don't have that open. But if we go here, what we're doing is like visualizing 30 years of the central banks and what they've done. So basically, following the 1997 Asian financial crisis and all this other stuff, central banks have been a net buyer of gold. Okay, what's the number one? Which country is number one in buying gold recently? From the end of 1999 to the end of 2021. So we're not even including this year. Number one, Russia. Number two, China. Number three, Turkey. India, Kazakhstan, Uzbekistan, Saudi Arabia, Thailand, Poland, Mexico. U.S. isn't anywhere in there. Gee. Now, what have I been talking about in terms of gold? We're faced with currencies are going to go digital. That's all in motion. Whether I like it, whether you like it, does not matter. We may be forced. Obviously, we'll be forced because you won't be able to buy or sell or move money around unless you do it digitally. And that's coming. China already has it in place. Number one, Russia already has it in place. What are they going to back that digital currency with? You can't back it like you do crypto, which is basically nothing, a worthless token. All right. You're going to have something if you want somebody to come and do business with you digitally. They've been buying up gold. They're going to back that currency with gold. Russia's going to back the ruble with gold, the digital ruble. This is serious stuff. And it's all out there. And we're trying to focus on whether the Fed's really going to raise or lower the rate come next Wednesday. There's a much bigger picture at work here. And that's, yes, we need to trade day by day, and I will. But I have the larger picture in mind, and it's not very pretty at the moment. It's not very warm and fuzzy. It spells a lot of danger coming up. Let's keep our eye on gold. Downside from here, I think it'd be very limited, but I have to tell you, in the past, I've seen these big rallies, and then right here, we had 2 days where gold dropped $150. Can we have that again? We can. I don't deny that it might stop right there and do a turn. And this is an A and this is a B, and then we get the C wave down, and it's going to be an irregular B wave. Markets are tossing those out there like there's no tomorrow, by the way. So we have a couple of things, but my guess is no, the intensity of this buying, I would think we get some follow through, but we'll see. We definitely will see. Now, mind you, there were some pretty big intraday. Moving down my hourly chart. Intraday, there was some strong selling. That was a strong sell, made that high, and that was at 993, and it traded all the way back down to 978. Pretty fast, very fast. And then after the close, by the way, after the close, they ran it up to the high, session high. So yeah, I can go either direction, but I do think that the market will continue to go up because there's just too much going on in the world that spells they want safety. So again, gold takes on a whole different tone. Is a storehouse of value. We've had this conversation. Go back and look at the podcast that I made with Dan Ascani, where we were talking about the power of gold, harnessing the power of gold, producing a return on an investment in gold. All these things are possible. You don't just have to be long or short. A lot of things you can be both and make a lot of money in gold. All right, over in silver, it also put in a little rally here. Let me go out to my daily. Very nice, but you can see not labeling it the same. I'm kind of sticking with these labels that this was the next. We got an A, a B, and we're going to have a C wave down. Not sure how that's all going to work, if gold's going to soar. So I may have to back it up and call this 1, 2, just like I am in gold. But if that's the case, silver needs to pick up the pace. Pick up the pace very, very strongly. So let me see how I did label this if I pull it out. Going to the B to the C to get the A, and then the A wave down almost came down to 50%. If I take that off, because again, being that I don't have what I would call the strongest count going in silver, and that's my fault. But if I'm looking here, if that's 1 and I can put my 2 there, then this would be minute wave 1, right? We've been looking at this is intermediate wave 2. We're looking at intermediate third wave. This needs to pick up the pace and go. If this is not going to be, this is ABC 2, and this is going to be 1, then that's got to be wave 2, and this has got to be starting of third. So we're going to watch. I'm going to pay very close attention to this, and also gold. But I still think just on a long-term basis, you start picking up silver coins. That may be helpful. Last on my list today, the dollar index, which is actually following the count. I got an A, so we're still in the B wave. I don't believe that B wave is over yet. We had a beautiful rally up. Now we're coming back down in the B wave. We've got past that 3A2, which is 103.9, 103.91. I think it did close below that on Friday. Let me just go right there and put that in. Yeah, it closed at 103.86. So just below that support level. So again, I'm looking for a B wave. If that's the A, that's the B. If I've been looking for a rally, and then this time we cleanly get above 106, start heading to 107. Here are our levels associated where a B wave could top out. What does that suggest? We're going to have a bond market that's going to turn and drop like a stone. That's one thing. Dollars will be in demand as we reestablish our positions. Okay, but we still have additional downside. If we still have additional downside, 103.351, 102.75 should contain it before we get that rally back up. Now, once this additional rally phase, and 107, or if it's 108 or 109 gets reached, I would be looking for the dollar to make us strong, just like this. Pop, boom, slide lower and end up below par, which is 100. I would expect it to end below 100, and for the euro to be the big winner there. And then, in fact, instead of, the dollar favor is always favored over the euro, would reverse. The euro would be higher than where the dollar is. So in any case, I would look for that C wave to come down below here, and I'd really be looking for this. Whether we start here or whether we start from there, it's going to be a nasty decline. It's going to be an A, B, and a C. That's the way I'm counting it right now. That could be a 1, 2, and a 3 for all I know. But right now, A, B, and a C. Third waves and C waves, they're cousins. All right, that's kind of where I'm going to end it for right now. I'm hopefully trying to keep this a little bit on the short side. Again, next week, big news is going to come on Wednesday. It's going to be the Fed. There's going to be a whole lot of hype. They're going to pull out everybody they can find to come in and give their opinion on what they think the Fed's going to do or what the Fed has to do, et cetera, et cetera. So just trade what's in front of you, folks. Make your decisions. If you need to hedge a long position in face of what could happen, do so. Do so. Learn how to trade puts. Learn how to put protection around your position. That's where I'm going to leave it. Our next update will be via the Elliott Wave update, and that will be tomorrow afternoon, early evening. Have a great week trading. The next podcast for the big picture will be next Saturday.